A man sits in a private banking office on the 42nd floor of a glass tower. He has just sold a company for $11 million. The wire transfer clears. For exactly 1 moment, he is sitting on more liquid cash than most people will see in 10 lifetimes. His private banker does not congratulate him. She asks him a single question. What are you going to do with this before the markets open tomorrow? This is the moment most people misunderstand entirely. They imagine that wealth, once achieved, finally rests, that the millionaire's bank balance simply sits there, swelling, safe, untouched. The popular image is a vault, a number on a screen, money parked. The truth is the opposite. To the people who actually possess large sums of money, cash sitting still is not safety. It is decay. Here is the belief almost everyone carries, quietly, without examining it. Cash is the finish line. Earn enough of it, and you have won. It sits in your account, doing nothing, needing nothing. And that is precisely the appeal's stability, finally, after years of chasing it. But the people who actually accumulate 7 and 8 figures do not treat cash this way. Surveys of high net worth households consistently show that individuals with over $1 million in financial assets, excluding their primary residence, are classified by the very metric used to identify them: liquid investable assets, not idle cash. The distinction sounds technical. It is not. It reveals an entirely different relationship with money than the one most people assume the wealthy have. A dollar sitting in a checking account is, to a sophisticated holder of capital, not a possession. It is a liability disguised as an asset, a quietly leaking container. To understand why, you have to follow a substance most people never think about directly: inflation, not as an abstract economic term from a textbook, but as a mechanism, actively working, every single hour, against anyone foolish enough to let large sums sit motionless. Picture a warehouse holding $1 million in physical bills, no transactions, no interest, just bills, stacked, untouched for a year. At the end of that year, even under historically mild inflation, that warehouse holds the same number of bills, but those bills now purchase measurably less. The money didn't move, but its power did, quietly, without anyone touching it. This is the first hidden mechanism most people never internalize. Holding cash is not neutral. It is a bet, an unconscious one, that prices will not rise. And prices almost always rise. Consider the arithmetic the way a private wealth manager would lay it out across a desk. A sum of money earning nothing, sitting untouched, loses a measurable share of its real purchasing power every year simply by existing. Stretch that across a decade, and the erosion compounds the way growth does. Except in reverse. The bills are all still there. The number on the screen hasn't changed. But what that number can actually buy has quietly shrunk year after year without a single transaction taking place. There is no dramatic loss to point to. No crash, no headline, no warning email from the bank. Just a slow, invisible leak that never shows up on a statement. Because a statement only measures how much money you have, never what it's actually worth. This is precisely why the wealthy do not treat idle cash as background noise. They treat it as the most basic, non-negotiable input into every financial decision they make. A silent tax that applies regardless of income bracket, regardless of effort. The instant money stops moving. So where does the money actually go? This is where the story expands. From one person's bank account into an entire hidden architecture of asset allocation that operates beneath the visible economy. The millionaire's money moves into equities, fractional ownership of companies that are, themselves, busy converting labor, machinery, and ideas into expanding revenue. It moves into real estate, where rent checks arrive whether the owner is awake or asleep. It moves into private businesses, bonds, funds, and increasingly into instruments most ordinary savers have never heard of: private credit, structured notes, interests in funds that hold stakes in dozens of unlisted companies at once. Cash becomes, for the wealthy, not a destination, but a brief layover, a holding pattern lasting days or weeks before being redeployed. Picture the actual mechanics of it. A dividend lands in a brokerage account on a Tuesday. By Thursday, a portfolio manager has already reinvested it into a fund, a bond ladder, a slice of a real estate trust. The cash never has time to grow stale. It is treated less like a possession and more like a relay baton. passed immediately from one productive use to the next. Because every day it spends sitting still is a day it is quietly losing ground. The author Thomas Stanley, who spent years studying actual millionaire households rather than the stereotype of them, uncovered something that surprised even him. The millionaires he studied were disproportionately found not in wealthy enclaves, but in ordinary, middle-class neighborhoods. And the explanation mattered more than the discovery itself. High-income professionals, the ones living in the visibly affluent neighborhoods, were more likely to spend their income on status and luxury, leaving little behind to accumulate. The quiet millionaires next door were doing something different with the gap between what they earned and what they spent. They were not hoarding the surplus in a savings account. They were converting it relentlessly into ownership. This is the first contradiction worth sitting with. The people who look rich are often the ones with the least retained wealth. The people who are rich often look unremarkable because their money isn't sitting in visible consumption. It's been redeployed into assets nobody else can see from the outside. But why does ownership beat cash so consistently? This is where the story moves from observation into mechanism, into the actual machinery of how capital compounds. When money sits in cash, it earns nothing or close to nothing, while the cost of everything around it rises. When money is converted into ownership, a share of a profitable company, a piece of productive real estate, it becomes attached to something that is itself growing. The wealthy aren't simply avoiding a tax on inflation. They're attaching their capital to the productive engine of the economy itself, so that as the economy expands, their stake expands with it. This single shift, from holding money to holding claims on productive assets, is arguably the single most important psychological and strategic divide between those who accumulate wealth and those who don't. And it explains something else too, why so many lottery winners and sudden cash windfalls evaporate within years. The money was never converted. It sat as cash, got spent as cash, and behaved exactly like cash behaves. It disappeared. Wealth that isn't converted into productive ownership has a half-life. Wealth that is converted tends to compound. Now the story scales further, because there is a second, more controversial layer beneath this one. It involves not just where the wealthy put their money, but how they access it without giving any of it up. Here is a pattern that has drawn intense scrutiny from policymakers and journalists alike, rather than selling appreciated stock to fund a purchase, which would trigger a capital gains tax. Some of the wealthiest individuals instead borrow against those holdings. They pledge shares or other appreciated assets as collateral to obtain cash through securities, based lines of credit, stock-secured loans, or bespoke credit facilities arranged through private banks and family offices. The asset is never sold. The gain is never realized. No tax event occurs. A securities-backed line of credit can let a firm lend against 70 to 90% of a portfolio's value, using the stocks themselves as the collateral, turning paper wealth into spendable cash without ever cashing out. This pattern earned a nickname that has spread well beyond finance circles. Borrow, die. Buy appreciating assets. Borrow against them instead of selling, and when the owner eventually dies, the stock passes to heirs on a stepped-up tax basis, resetting its cost basis to the value at death and erasing the capital gains tax that would otherwise have applied to decades of growth. It sounds, on the surface, like the entire secret, a clean loophole, elegantly closing the loop between wealth and tax. But here is the deeper, less reported truth, and it matters. Researchers examining the actual financial behavior of the ultra-wealthy have found that aggressive borrowing against assets is, surprisingly, more characteristic of middle-class households than billionaires. The data complicates the popular narrative. Many of the wealthiest individuals are not leveraging dramatically against their fortunes at all. They are earning substantial taxable income through salaries, dividends, business profits, and realized gains, spending only a fraction of it, and quietly reinvesting the rest. This is the second contradiction the documentary uncovers. The headline-grabbing tax trick is real and used by some, but the dominant, less cinematic strategy of the truly wealthy is simply this: earn more than you consume and convert the surplus into ownership year after year without drama. Which raises an uncomfortable question. If the actual mechanism is this simple, spend less than you earn, convert the rest into productive assets, why does it remain so rare? The answer isn't mathematical. It's psychological. Cash feels safe because it feels controllable. You can see it, touch it, in a sense. It doesn't fluctuate in front of your eyes the way a stock portfolio does during a volatile week. This feeling of control is precisely what behavioral economists have spent decades studying. The comfort of stability outweighing, in the moment, the certainty of erosion. Holding cash is the financial equivalent of standing perfectly still because movement feels risky, even while the ground beneath you is slowly sinking. There's a deeper psychological trap hiding inside this instinct too. Losses that happen in a single, visible moment. A stock dropping 10% in an afternoon. Register as painful, immediate, almost personal. Losses that happen invisibly, a fraction of a percent at a time, month after month, barely register at all. The mind is wired to fear the dramatic loss and ignore the quiet one, even when the quiet one is, over time, far more destructive. This is precisely why cash feels like the responsible choice even as it performs the worst. The wealthy are not immune to this instinct. They've simply been forced, often through losses early in their financial lives, to confront the cost of standing still. Once that cost becomes visceral, once someone has watched a stagnant sum quietly lose purchasing power over a decade, the discomfort of market volatility starts to look smaller than the certainty of decay. This reframing changes the scale of the story entirely, because it isn't really about millionaires. It's about an entire economic ecosystem built around the assumption that capital should never rest. Banks lend out deposits rather than vault them. Companies issue shares precisely because investors expect their capital to be put to productive use, not stored. Real estate markets exist because property generates income when occupied, not when empty. The entire modern financial system is, in a sense, an elaborate machine designed to discourage stillness, to pull money out of mattresses and safes and idle accounts, and put it to work generating more of itself. Millionaires aren't defying this system. They are simply the ones who learn to move with it instead of against it. And this is where the story arrives at its quiet, uncomfortable center. Most people are taught to save. Almost no one is taught to convert. The financial education most households receive, if they receive any at all, stops at the idea of accumulation. Earn money, put it somewhere safe, watch it grow slowly through interest. What rarely gets taught is the second step, the one the wealthy treat as obvious. Safety itself is not found in stillness. It's found in motion, in attaching capital to something productive enough to outrun the quiet, constant erosion that comes simply from holding still. The man on the 42nd floor, the one who just sold his company, will not keep that $11 million sitting in an account collecting nothing while prices around him rise. Within days, it will be scattered into equities, into property, into instruments designed to keep it growing, working, multiplying. Not because he distrusts cash, because he understands, in a way most people never get the chance to learn firsthand, that money was never meant to rest. It was only ever meant to move. If you're enjoying these money breakdowns, subscribe now so you don't miss the next one.